Hi there, this is First Principles on August the 30th, and we'll be taking a look at the United States Steel buyout situation. Please note that the information discussed here is for informational purposes only and not intended to be investment advice. Everyone that is watching this video, please do your own research before making any investment decision, and ultimately you are responsible for your own actions. Now with that disclaimer out of the way, let's get on with the show. So let's take a look at a quick summary of events that has been happening for the last 2 weeks. So on August the 14th, Cleveland Cliffs offers a $17.50 per share in cash offer in addition to 1.023 of their own shares for every share of United States Steel. On the same day, another private equity firm called S-Mark bids $35 in all cash for every United States Steel share. And then on August the 23rd, S-Marks drops their bid for United States Steel. And most recently, as of yesterday, United States Steel announces that it's reviewing other unsolicited bids for their company. If we're to take a look at the current price of the company, if we go to MSN Money, we can take a look at the current share price. And as of the close of August 29th, we can see here that it closed at $30.87. While S-Mark bid $35 in cash for every share of this company, that bid is currently off the table. And the reason why they dropped this bid is that they felt that there would be some complications in terms of them acquiring the company and lacking the support of the union. The company, the board of directors and the owners of the company themselves have mentioned that they have the right to go ahead and maximize the value in terms of what they want to get to their shareholders. And so what's been discussed so far is that when compared to the union, the ratified agreement between themselves and the union is that the union may offer a bid which is higher than what is offered to the company if they have another offer on the table. We'll see how that plays out later on, but my personal thought on that is likely there'll be a fairly small chance of the union having the capability to veto any sort of merger should a good offer come in for the company. If we're to take a look, do a quick valuation calculation of the company, I pulled up the revenue historical information that's been published in terms of their revenues and computed based on the trailing 12 months related data. To me, probably the most important information is the net income column. Another column that'd be good to look at is also the free cash flow. But for now, what I'll be basing the calculation off on is the net income. And what we're seeing here is that for the trailing 12 months of net income, we're looking at $1.3 billion in terms of income. And the idea, the way to value this company, well, the way I would look at it is I'm going to use a DCF, a discounted cash flow modeling for this company. And I'll apply a internal rate of return of around 11%. And the reason for that is I'll be applying a 4.25%, 10%, which is the rate of the 10-year U.S. Treasury government bond, and I'll be adding about a 6.75 risk premium to this company. This is just a personal number that I'm using. Everyone will have their own numbers that they will use in terms of how they want to calculate their own hurdle rate for the risk of return. And at least for the numbers that I'm using is I'm setting a target premium of about 11%. In terms of growth of the company, the steel sector itself. There's a lot of variance in terms of the price recently. We can see here that for the trailing 12 months numbers, that for the last few quarters, the net income has been going down. This is basically due to the economic slowdown, reduction in terms of the steel consumption, also reduction in steel prices, resulting in this reduction in price. So right now, I'm just going to consider the last posting of the last 12 months of data to be sort of the steady state and apply a nominal 2% inflation rate to the net income. Now, if you want to give yourself a little bit more, a bigger margin of safety in terms of your calculation, what you could also do is you could also modify your expected value in terms of the net income, and then use that inside of the discounted cash flow model to calculate what would be your net present value of this company. Now, using these values, I come up with a DCF total of about $16 billion. And the calculation for that is all computed down over here. And so the net income value over here we see is going to be growing about 2% every year. And then I apply the discount rate of 11% for every year. And we can see here that this calculation goes out for a while, and I've pulled it out to about 100 years. And pulling out this calculation to 100 years and then summing the total up will give this discounted cash flow total. Now, of course, there can be some arguments in terms of, what is the good number of years to use for discounted cash flow total. And that really depends in terms of what is I think the biggest thing you would think about in this case is how much does the years that are further in the future would impact the value, and does it make sense to calculate that number? And so since interest rates have gone up recently, and the target premium that I'm putting in here is 11%, we can see that the discounted cash drops off quite significantly going off into the future. So even if I were to take, say, the current year and go out to 20 years, that'll bring me up to about $13.7 billion in terms of discounted cash flow. So we're, even at like a 20-year model, we're talking about a difference in about $2.8 billion. So, whether you're using a 20-year or 25, the change in the valuation of the company won't be particularly large. So I'm considering this model to be going out to 100 years to not have a significant impact in terms of the calculations of the numbers. And then what I'm doing in addition to the calculation of the DCF is that I'm taking the equity value, and the equity value is pretty much all the stored value within the company in terms of how much cash they have, the amount of revenue they should come in, minus liabilities, and anything else that they would have as an intrinsic value of the company. This is sort of like the book value. And I'm going to apply a conservative 50% haircut to this value and then add it to the DCF total. And this brings me about $21 billion, $21.8 billion in terms of total value of the company. So from the annual reports, I get about 222.9 million shares outstanding. And if I were to divide the total value, the DCF plus equity value, with the multiplier value that I put in, I calculate a $98 per share price using this model. So comparing this number versus, say, the S-Mark bid that they put up for $35, one might think that the bids that are coming in for U.S. Steel could be significantly lower. If you want to apply some level of safety, so for example, if you're worried that the net income might continue to drop, and so we could model that as well. And so we could say, what if the net income were to drop, say, 25%, and then calculate that value? And so I've just put in that number here, and the calculations have come back. Oops, that's 75. That should be 0.75 instead. And then we'll recompute the numbers, and we'll see here that the number comes down to about $79, close to $80. So even if the net income comes in a bit lower, in terms of a safety factor, the $35 that S-Mark has put out there is quite conservative. And so what I'm thinking here, as my opinion, is that the bids that have been offered by Cleveland-Cliffs as of the moment and S-Mark are coming in quite low in terms of the valuation, and I probably expect a little bit higher numbers in terms of the sale price that United States Steel would accept. And that number, I currently don't know what that could be. So, at the $35 range, the value that people were putting out at first was close to about $7.3 billion. In order to do a purchase at higher numbers, maybe at $40 or more, we'd be looking at around 10 billion or more in terms of the purchase price. So the question will be, if a company does come in, they would need to have around $10 billion worth of capital or some kind of value that they would need to put out in terms of financing to buy United States Steel. And the question becomes, who could be those companies that buys United States Steel? Now, we do know that Cleveland-Cliffs still has an active bid for United States Steel. So how about let's take a look at what's going on with Cleveland-Cliffs and how they might execute a deal. So what I've done in terms of Cleveland Cliffs is that I've gone to their webpage, to their investor relations page, and I pulled out their 10Q, or the quarterly earnings report. And the most recent one they have is July 26th of this year. And if we open this report up, we can see here that this is the Cleveland Cliffs financial report for as of for the July 23rd. We can take a look here in terms of what do they have available in terms of their assets. So this will give us information of what kind of cash or whatever they can use to deploy for this kind of purchase. We can see here that for as of June 30th, 2023, the cash and cash equivalents is only sitting at about $34 million. And they have $2.29 billion in terms of receivables. And so this is the amount of money that they're expecting to be paid from their clients. So this is money that they don't have on hand. And usually what happens when clients buy steel from these, or buy items from these kind of companies, is that they'll put in the purchase order, a delivery will go out, and there'll be some period later, 1, 2, or 3 months in the future, where the company gets paid. And then on the inventory side of things, they got about $4.7 billion worth of steel. So I doubt that they'll be able to use any of those resources in terms of buying a steel company. So if we think about cash on hand, they've only got about $34 million in cash. So if they were to finance that $17.5 per share purchase of United States Steel, they would definitely have to go out to some kind of bank to get a loan for this amount. Maybe they might have to issue more stock, or they have to issue some bonds, go to issue some debt, and then make that purchase. So it'll be interesting to see if Cleveland Cliffs does execute on this, how would they finance the deal. And personally speaking, without that information, like, we really don't know if it is a feasible thing for them to do or not, until they announce how they're going to fund it. So that would be an interesting thing to look at. And importantly, when looking at the other bidders that will be coming in to buy United States Steel, if their offer is coming out, of course they can put out an offer, but the important thing is making sure that the other offers that are coming in are able to execute. So if we come back here, so to buy them out, maybe for the full value, even with like a 25 haircut to the current net income, puts the company valued around $17 billion. The question would be, at what price would someone be able to buy this at? So could it be around 10 billion or 15 billion or something like that? And that will have an impact to the share price. In terms of what I think the company is valued, well, at least from the numbers posted here, based on the target premium, I think the company should be valued more than $35. And so if we come back to the current, the last closing price around $30.87, if a deal does happen, one would hope that a number that's higher than this, maybe around $40 or $45, does come in. But the question is, who will be able to come in and make that purchase? Now, because of this, maybe there might be no one that has the money on hand to make this purchase, and it falls through. So what would happen to United States Steel, the price of the stock? If we were to take a look at the last 3 months in terms of the share prices, it's been hovering around $24, even below that, as low as $21. So I think in terms of valuation of the company based on the cash flows and a DCF model, I do think that this company is fairly undervalued. And the question really for me would be, in order for that value to be realized, is what would be the buyout price that someone's willing to put in to buy the company? And for the time being, I think that will be the biggest indicator in terms of how to realize the value of this company. But whoever does have the cash to buy this company might be able to buy this company at a decent deal. So if it's like at $40 in terms of per share, or $50 in terms of per share, they're still getting a very good deal if their, say, internal rate of return is around 11%. So the big question is, whoever else is buying this company, what is their internal rate of return, and how would they do the calculation in terms of making a purchase for this company? But as of the moment, with the way that things sit right now, the current bids probably are looking on the undervalued side. So I don't know when this will close, but I'm hoping maybe in the future we'll be able to see this company have some kind of buyout transaction around $40-$45, maybe higher if possible. So I hope there is potentially there could be some money on the table upside in terms of this position. So that is my quick analysis of this stock and the current events, and will be very interesting to see what happens in the coming month. Thank you very much for your time.